Okay, so let's go ahead and let's just review, make sure that we're all comfortable with the quintessential slide in this chapter in this class, really, that we all have to know. So let's sort of try to do this all together. Asset, if you want to increase it, you debit it. You want to decrease it, you credit it. Good. Liability, you want to increase, you credit, decrease, you debit it. Revenue, you want to increase, you credit it, decrease, debit it. Good. Expenses, you want to increase, you debit, decrease, you credit. Good. Equity, you want to increase it, you want to increase it, you credit it, decrease it, you debit it. Good. Okay, all right, so this is sort of the basic thing that we have to sort of just have running in the back of our minds at all time as we're looking at this stuff, right? Okay, so with that, now I get to go and have fun to try to escape out of this because it doesn't like to let me escape out. That time it worked. And let's go ahead then and let's take a look at this exercise that we really went through last time. And as I said, there is a recording of this now where I go through the whole thing already on Canvas. But let's take a look at it again. And so we can see here that this company issues stock for cash. Okay, and when they do, let's see if I can get the pen up here. There it is, review, get the pen up. Okay, and when they go ahead and they issue the stock for cash, we of course debit cash, and we're going to credit the common stock, right? Okay, debit on the left, credit on the right, right? Okay, and so what happens? When I come over here, I'm going to enter that into the ledger. What do we call that process? What do we call that process? Now, this was the journal entry. Huh? Posting, right? The journal entry is over here, where we did the debit on the left, credit on the right, and then what? Then we come over here, and we're going to enter into what? We're going to post into the ledgers, right? Okay, so we have assets equal liabilities plus stockholders' equity, and you wouldn't see all this in the ledger assets equal liabilities plus stockholders equity, but you would see the cash account. We just debited it and we credited what? Common stock for the $1 million, right? And then we always show the balances there as we go along. Now, these entries over here we're going to be posting. You would sort of have to use your imagination here. Those aren't there yet, right? As we go through and we start to post each entry at a time, right? Okay, so then you come over and you take a look, and we have this next journal entry where we bought a building for $1.2 million. And when you look at this, we don't have $1.2 million, but we purchased the building anyway. Since the building is an asset, we debit it, right? And the guy says to us, that's okay, you can owe me the $200,000. So we have a bill, don't we? We have a pay a bill, we have a liability, so we go ahead and we credit that $200,000, and then of course we're going to give the guy the down payment, the cash. When we credit the cash, that decreases the cash. The cash is now zero, right? Okay. Then what's going to happen? You come over and you take a look, and of course we have to set up that mortgage payable. They call it a mortgage because it's probably we're going to die before we pay that off, right? So we'll face our mortality before we pay that off. But we go ahead and we credit that, right? Okay, assets are still equal liabilities plus stockholders' equity. And then I think in our little example, we said that we were doing some sort of DJing and we need a van, etc. for our equipment. So we go to purchase the equipment. The guy says, well, you got any cash? We tell him no. He says, that's okay. If you don't pay me, I'll take your building, whatever. I know that you have what? You have that capital there, that building. So I'll go ahead and I'll let you take this this vehicle, and you don't have to leave me any money. So what happens? Is the vehicle an asset? has future economic benefits, so we go ahead, we debit the equipment. When we do, the balance goes up to $1,500,000 in our ledger, and then we go ahead and we post over to our liability, our vehicle payable, $150,000. We have our liability. Assets are still equaling liabilities plus stockholders' equity, right? Isn't this a beautiful system? Don't you love accounting, right? It's all working out for us, okay? Then what happens? Then we get our first gig, and the gig is for cash, $200,000. Not bad, right? So since we got some cash, we debit the cash for $200,000. Is cash an asset? So we want to increase it, so we debit it. So we go ahead. We see now that the balance in cash has gone up to $200,000, and we're going to now recognize a revenue. And so you come over, and we're going to increase our revenue. So we're going to credit our revenue for what? For this $200,000, and I put that under stockholders' equity because ultimately that's going to increase my retained earnings. Remember, our common stock and our retained earnings make up our stockholders' equity. Revenue will increase it, and our expenses will decrease it. So when we close out our net income, we'll close it to retained earnings. That will bring up my stockholders' equity. So that's why I put revenue under the stockholders' equity here. Okay, so we go ahead and we continue on, and we have to pay some expenses. I think last time I called this out as cash or something. As gasoline. I should say that we were having to pay, and I didn't read my own example very carefully. It's salaries that we're paying. We got to pay our DJs or our movers or whatever it is that we have to pay. So when we pay them, we're paying them in cash. We debit expense, we credit cash, right? Where are our expenses reported? On our income statement, but we go ahead, we post over to our expenses. Now our expenses are up to $70,000. We're going to bring in those other journal entries that you see down there in a minute. And of course, we credit cash. So now my cash has this $130,000 in it because I just subtracted it by crediting it, right? Okay. Now at this point, I'm looking and I'm saying, okay, not bad. I'm sitting here and I have my information for the year that I should be able to go ahead and prepare my income statement, right? Okay, so I go ahead and I do that, and I'm just going to go ahead and write that in. Okay, so I'm going to put in my revenue. I'm just writing it over here so that it'll fit. How much is my revenue? I look to my ledger account. The revenue is what? 200,000. Okay, so there's my revenue, 200,000. Okay, good. And then I need to put in my expenses, don't I? Okay, so I put in my expenses. Isn't this fun? And my expenses are how much? 70,000. Good. So I stick that in. Difference between revenues and expenses now. I'm trying to make that a 0 there. Difference between revenue and expenses is called what? Net income. I'm just going to put NI to abbreviate it. Net income. The net income is 130,000, right? Okay, good. Not bad for a year's work, right? I'll take it. 130,000. Okay. Okay, good. So I've gone ahead and I have prepared that. Now, the voice, remember that voice that started the lemon tree thing off? It says, hey, I want a dividend. I told you I was going to come back and ask you for something. I'm asking for a dividend. I'm asking for 10% of what you made. And we say, okay, that's not bad since you started us off in business and since you can destroy us with the blast of your nostrils or whatever it is they say about the voice. We're going to go ahead and we're going to do what? We're going to pay him a dividend. We're going to debit dividend $13,000 and credit cash $13,000, right? Now, when we credit the cash $13,000, obviously it comes down to $117,000, and I'm going to do what? I'm going to look at my dividend account. I'm going to debit my dividend $13,000, so the balance comes up to $13,000, right? And so now I'm ready to prepare my second statement here, which is going to be my statement of retained earnings, right? Okay, and on my statement of retained earnings, SRE, statement of retained earnings. I'll show a beginning, put the E first, John, beginning balance. And my beginning balance was 0, wasn't it, since I just started business here? Okay. Then I'll bring down my net income here. My net income is going to increase my retained earnings, isn't it? Because I want to retain that net income. I'm going to retain that. That's 130,000. I pop that in. But if I paid a dividend, did I retain all the earnings? No. So I'm going to add the net income, but I will subtract, and put the word less here, the dividend. How much is the dividend? 13,000. Good. I subtract that off. 13,000. So the ending balance in retained earnings, I'll just put EB here. For ending balance, got to be what? 117? Okay. Okay, so I'm able to sit there and sort of do math, a math equation to come up with my statement of retained earnings, right? But what did we say the other day? We're going to get a T-shirt or a license plate or something that says accountants do it with journal entries. So we have to actually make journal entries to get that 113,000 into the retained earnings, don't we? Okay. And so those journal entries we call closing journal entries. So let's go back to our journal and let's start to make the closing entries. So we're going to go ahead and debit revenue 200,000. Debit revenue 200,000 to close it, and credit income summary 200,000. And when we look back at our revenue now, we post that debit to revenue, and revenue is closed. It's 0 now, isn't it? Which is where we want it to be so that we can start next year all over again with 0 revenue as we keep track of year 2's revenue, right? Okay. Okay, good. So we got that closed. We credited that to income summary. So for a second, income summary is showing me a credit balance of 200,000, right? No worries. I'm going to get rid of that pretty quickly. I'm going to bring that down to my net income number here by now debiting income summary for 70,000 and crediting the expenses. That's in my journal. I come back to my ledger. I post that. Aren't you glad God invented computers? Right? Because you're going to see in a minute how the computer is going to do this all for us. And so I'm going to go ahead and credit my, credit my income summary. Say it again, John. Speak slowly. I'm going to credit my expenses. That closes my expenses, doesn't it? I credited my expenses. That closed my expenses. And I'm going to do what? Debit my income summary. So now we're just showing 130,000 in there, right? But I want to get that into the retained earnings, don't I? Okay, so what do? I come back to my journal, and now I go ahead, I debit my income summary. That's going to 0 that out, and I do what? Credit my retained earnings. And so I come over, and that's what I do. I debit income summary 130,000. Now it's 0'd out, which is what I wanted because I'm going to use that next year to keep track of everything. I credit my retained earnings, and now it has 130,000 in it, doesn't it? Okay. But what happened? I did pay that guy the dividend, the voice the dividend, whatever. So I'm going to debit retained earnings 13,000, credit dividend 13,000. When I credit dividend 13,000, because I want to keep track of those by year, the dividend is now 0, isn't it? Dividend is 0, and of course I debit the retained earnings, just posting that, and now the retained earnings has the 117,000 in it, doesn't it? Okay, so I should be able to go ahead and prepare my balance sheet now. So let's just go ahead and try that. If I can squeeze it in right here, balance sheet. It's going to be right here, cash. And I pick up my cash. My cash is how much? 130,000, just picking up, not 130, 117,000 right there. Just picking up the balance there. It's 117 after my dividend. So that's 100 and what? 17,000. Good. Then I have what? Any other assets? Cash is an asset, so I'll list my assets there. That says assets. Cash is an asset. Any other assets on my balance sheet? Building. Good. Building is going to be what? 1,200,000. Good. Got that. I'm just picking the number up there, right? Right? Anything else? The equipment, the vehicle, we'll just call it equipment for short, EQ. That's what, 150,000? Got that. Okay, good. Any other assets? That looks like that's it. What was our total here again, guys? Total assets? Why is that not sounding right? 117,000 plus 1.2 plus 150 is what? 1,467,000. Is that right? 1,467,000, like that. I'm going to recommend a piece of equipment, a tool that was invented a while back that is mandatory for this class. It's called a calculator. It has numbers on it, and you press in the numbers, and then it reads out the numbers that you pressed in on a little window. And then you hit the plus or minus sign, and then you hit equals, and it figures all this out for you. Okay? I think I've said this now like, what, 50 times? You got to bring your calculator to this class, guys. You bring your calculator, you use it religiously like it's your God, right? Okay? Okay. So we got this 1,467,000. And now we can go ahead with what? Our liabilities? Okay, we're done with our assets. Let's pick up our liabilities. And we have what? The mortgage payable? Is that a liability? So I'm just going to call that MP since we're making a mess up here and I don't want to keep writing all kinds of stuff. That's 200,000. Anything else? The vehicle? The vehicle payable, I'll just call it payable. 150. Any other liabilities? Okay, so our total liabilities now, even I can figure that one out of my head, is what, 350? Okay, for my liabilities is 350. That's my liabilities. Okay, good. Now what? Now I need my stockholders' equity. Stockholders' equity. How much is my common stock? $1 million. So I got common stock of $1 million. Good. Anything else? Stockholders' equity. Retained earnings is 117, isn't it? Okay, good. I'm kind of running out of space here, but look good. I got a little bit more. So what's my total retained earnings? 1 million. My total retained earnings is 1 million. I mean, my total stockholders' equity, excuse me. Total stockholders' equity is how much? 1,117,000 is the total stockholders' equity, and now my liabilities plus my stockholders' equity is what? This 1,467,000. Does my balance sheet balance? What would I do if it didn't balance? I would beat it until it did. I would continue to search for what's wrong because there's something wrong if it doesn't balance, right? Something is wrong. If it doesn't balance, 1 entry, 2 entries, 3 entries, 5 entries, whatever, right? This is why we have computers that do this, right? For us, and we're going to practice with that in a minute. Any question on that first year? Okay, good. So we get through the first year. In accounting, your reward for pulling your financial statements together for the first year is to do what? Start on the second year, okay? That's what happens. Once you close the financial statements for year 1, you get to start to work on the financial statements for year 2, okay? So let's go ahead and let's start out year 2. And let's just start out taking a quick look at our ledgers over here. And notice, guys, that all the balances on my balance sheet accounts came forward, didn't they? Okay, all the balances from my balance sheet accounts that we were looking at before came forward there. And you're saying, well, what are these other accounts? Those we're going to generate this year, okay, in year 2. There's my mortgage payable. All these beginning balances came over, didn't they? These are the beginning balances, okay? Just like when you go to sleep at night and you, on December 31st, you wake up the next morning, the same amount of money is still sitting in your wallet, right? Okay, unless you live in a bad neighborhood or something, but hopefully you are able to find that same money in your wallet the next morning. Okay, then what? There's our common stock. I didn't put beginning balance there, but it's still there. There's my retained earnings beginning balance, right? 117,000. Notice my income statement accounts, I zeroed them out so they could start keeping track of what's going on this year now, right? Okay, those are what? Say again? For the next period? Right. We call those temporary accounts. We call them proprietary accounts. There are different names for them, but they are trying to indicate to us by those names that they are zeroed out by the beginning of the next year, right? Okay, we zeroed them out the end of last year. Okay, good. So we come over now, and let's just start looking at our journal. And we decide that we need some cleaning supplies. I don't know, whatever we need of supplies, wires for our DJ business, whatever. And so we go ahead, let's make it cleaning supplies. And we go ahead and we debit our supply account. And when we go to the supplier, remember the guy with the fertilizer? Same kind of thing. This guy says, oh, no problem. I love your DJ work. Just pay me at the end of the month, right? I'm a big fan. You can just pay me at the end of the month, whatever, right? So we say, oh, okay, great, thank you. So what happens? Our cleaning supplies have future economic benefits, so they're an asset, and we go ahead and we debit supplies, and there's that $24,000 worth of supplies we have, right? Now, you come over. Did we go through year 2 last time? I couldn't remember for sure. We did not? Oh, okay, good. So this is useful. Okay, and then what? Then we go ahead and we take a look at our liability down here, which is the $24,000 for the cleaning supplies, right? Where'd that go? There's the debit supplies. Oh, my liabilities are up here. So I go ahead and I would do what? I credit my liability in my ledger accounts. I make the journal entry in my journals. I post in the ledger, right? Okay. Okay, good. Then I come over and I'm going to do some DJ work, and it's $40,000. And the guy tells me in advance, he says, look, this is a heck of a party, but we're not going to be able to pay you cash at the end of the night because we don't want some of the, unscrupulous characters that we have at this dance seeing all this cash. We'll send you a check for it, right? And we say, no problem, just pay us at the end of the month, right? And so what happens? If that's the case, we are going to, and I skipped it. I described the wrong transaction. Why did I skip everything? What is this? Where am I? How did I get all the way down to supplies already? Okay, let me go back up. The supplies is fine. We bought supplies and I put it in the wrong place. But the way we did it is fine. But let's go back up and let's deal with this generation of the revenue here. Okay, and so it happens. We provide the service not for not for 40,000, but for what? 100,000, and the guy doesn't want to be, flipping $100,000 in cash to us at the end of the night. So he says, "I'll pay you at the end of the month." We say, "Fine, right? No problem. That's $100,000." So what do? We go ahead and we set up our receivable now. Do we have a future economic benefit? That person's going to send us that money, so that receivable is an asset. We debit the asset, and we credit what? We credit the revenue because we have now provided this service revenue for this DJ job, whatever, right? Okay. Okay, good. Then what? Then you come over and you take a look, and I did the supplies already. I need to make sure I come up all the way or I'm going to miss these entries. And I thought I did talk about this. I realized that I'm driving without insurance. Okay. You can't drive without insurance, can you? So I said, I better buy my insurance, and I buy essentially a 2-year insurance policy, right? And when I buy that 2-year insurance policy, I go ahead and I debit my prepaid insurance, 1.2 1,200. It's a 2-year policy, and I go ahead and I debit my prepaid insurance over here. Where'd you go? I guess you're down. There you are. Prepaid insurance, 1.2. Is that an asset? Because I have that insurance, right? It's prepaid. It's going to be useful for me for how many years? 2 years, right? So I debit my prepaid insurance. That's an asset. And since I paid that in cash, I'm going to do what? I'm going to credit the cash for the 1,200, right? Okay, good. Then what? Then I go ahead and I come over, and a guy comes up to me and he says, "Hey, I hear that you do some pretty good DJ work." I say, "Yeah." He says, "Well, look, I'm having a huge party. Here's 120,000. I'm going to throw a party every month for the next 12 months. Here's 120,000. It's $10,000 a month work. Take this 120,000 now, but make sure you show up. Because if you don't show up, I'm going to send my boys over here to get the money back, right?" And I say, "Okay, no problem." So he gives me the cash, right? So when he hands me the cash, I sit there and I say, "Okay, I've got this cash, 120,000. I'm going to post that 120,000 over here to my cash ledger." My cash balance now goes up to this 235,800 because I have that 120 that I just brought in. But I haven't earned that revenue yet, have I? I still got to provide them that service over the next 12 months. And so I actually credit. This is a liability. Notice we're still under the liabilities. I credit a liability account called unearned revenue because in the event that somehow I can't live up to my obligation to provide him that service, I got to give him the money back, don't I? If I don't, he's going to come see me, right? So I go ahead and I put that into my unearned revenue account. So I have a liability there now, don't I? Okay. Now what happens? Now the guy, remember this guy up here who had hired me and he said, "Hey, I'll pay you back a little bit later." This guy, the account receivable guy up here, he goes ahead and he flips me down some of that cash now. He gives me 40,000 paying on that bill, right? And he says, "I told you I pay in 30 days, but here's 40,000, 15 days early. I'll get you the balance, in another 15 days, whatever," right? And we say, "Okay, not a problem. We trust you." So what happens? We come over and we are going to debit the cash for the 40,000 and we're going to credit what? Accounts receivable for 40,000 because we're now only expecting 60,000 more from him. But I say, "Give me another 40,000. He'll give me the remaining 60,000, right? Right? Now let me ask you a question. Did my assets change? Did my total assets change? Total assets stayed the same in that what? Cash came up 40, but my receivable came down 40, didn't it? Cash went up 40, my receivable came down 40. So the total assets stayed the same, right? Okay, I just replaced one asset for the other. So I go ahead and did I post those? Yeah, I posted them, right? Okay. So now what? So now I come to the end of the year, and the guy came to me on July 1st with that 120,000, and now by the end of the year, I've done what? I've provided him with how many shows? 6 shows at 10,000 a month. Okay? God gave you fingers to count on your fingers for questions like this. It is very easy to think you know the number of months and mess it up, right? So it's what? July, August, September, October, November, December. I promise you, if you don't do it like that, you're going to make a mistake, and then you're going to say, "Oh, how come?" And the way we write the test, we'll put the common mistake answer as the first one. You're going to think, "Oh," and be in a hurry and think you got it. You're going to have plenty of time to work your exam. Just slow down when you get a question like this. 1, 2, 3, 4, 5, 6. When I was studying for the CPA exam, 1, 2, 3, 4, 5, 6. My dad used to say, "What are you going to be, an accountant that counts on your fingers?" And I'm like, "Yes, I am. For questions like this, I'm counting on my fingers." "Dad, get out of here. You don't know what you're talking about." Okay? So what happens? You go ahead and you do what? You debit the unearned revenue for 60 because we've now earned that, haven't we? And we credit revenue for 60 because what? You come over to our ledgers, and when we post it, notice that we now have a balance in our liability, our unearned revenue account of 60,000, don't we? Don't you love accounting? Look at the beauty of this. Now the world knows that we have what? That we have, they don't know the details unless we give them a footnote, but they have a sense anyway, just from this account, that we've got another 6 shows left to go that it's going to be $10,000 a month for it, isn't it? And we're liable for that. The guy's going to come looking for us if we don't pay him, right? Okay, and so what happens? We got that 60,000, but the world also will know now that we are $60,000 richer in our revenue for having what? For having done that work. There's that first show, and remember the first show now, we don't even have all the cash on that yet, but we still took the revenue, didn't we? The second show, we have the second set of shows that we're going to do, we have what? We have cash already, and we've only taken half of the revenue for that, haven't we? Right? What happens? We sat here, and we got, for the first show, we got revenue out of that of what? For that first show, we got revenue of that of 100,000, didn't we? Did we get revenue of 100,000? But so far, the guy has only paid me what? This is what you do with accounting. I'm going to look right at my accounts receivable. I know he's only paid me just by, if the guy called me up and said, hey, John, how much have I paid you so far? The beauty of accounting. You have paid me $40,000. You still owe me 60, don't you? Doesn't he? Right? But we've already taken the full what? The full 100,000 of that revenue, haven't we? We've already taken, if you look at the revenue count. So the collection of cash is not what drives the recognition of revenue. It's what? It's the providing the service that caused the revenue to be recognized, right? In the other case, the guy gave me the 120,000 up front. I didn't take the revenue until I had provided the service, right? Right? And I've only taken 60,000 of that, even though he gave me full 120,000. So sometimes students get confused. They're thinking your cash matches your revenue. No, if I get the cash in advance, it won't affect my revenue until I do the service and earn that revenue. If I provide the service and I'm going to get the cash later, I'll take the revenue now, and then the what? Receiving of the cash is simply an argument between what? Between the cash and the receivable account, right? And we just move it from one asset account to another as that cash comes in. This is what they call accrual accounting, right? Okay? Okay, good. So we go ahead and we do that. Anything else now that we have to worry about? Let's see. Oh, okay. That insurance. We bought the insurance, and we bought it on January 1st, I guess, for the full 2 years. It was, what, $1,200 when we bought it? So now we have used up half of it by the end of the year, haven't we? Right? So what happens? 600 of that has expired. If it has expired, we take an expense for that, don't we? And I'm, doing the annoying, emphasis on the similarity between those words, right? Okay, so we go ahead and we debit the insurance expense now because, 600 of that asset has expired. And when we do, we come over and in the in the prepaid insurance account, we post that credit showing that we have $600 left. Isn't it beautiful? We got one more year, $600 a year. You can look at that and see exactly what you have left. Doesn't that just bring tears to your eyes? The beauty of it? Okay? Then what? You say, well, it may bring tears to my eyes. I don't know if it's over beauty or not. And then what? And then I go ahead and I did what? I debited my insurance expense for this what? For this $600 right here. There's that debit to the insurance expense for $600. Okay. Did I miss some transactions? Looks like I did, huh? Huh? Oh, okay, good. So we're going to keep going. Thank you. So I have some more expenses, and what happens? I say here that a count of the supplies shows that there's 13,000 that are still remaining. A count of the supplies shows that there's 13,000 that are remaining. Now remember, we bought what? We bought 24,000 worth, right? If you bought 24,000 apples and you go and you count and you see that there are only 13,000 apples left, how many apples did you eat? 11,000. You'd say, well, you have a stomach ache, so who cares how many you ate? How many apples did you eat? You ate what? 11,000, didn't you? You want me to do that again? You have 24,000 worth of supplies. You're not really keeping track of them as you use them, but you go back and you count. Hey, there's only 11,000 of supplies left. What happened? 13,000 got used, didn't they? Okay, so what do I mean, there's 13,000 left. 11,000 got used, didn't they? Okay, and so what happens? You go ahead and to show that those have expired, they got used, you debit the supplies expense, 11,000, credit the supplies for 11,000. When you credit the supplies for 11,000, isn't that beautiful? It shows me exactly what I have left, right? And it also shows me that what? That 11,000 now have expired, haven't they? And I put that into my expense. Now, guys, so this could sort of fit nicely all on one page. I didn't have a separate supplies expense account because I don't want to, have to do 52 different accounts. You don't have just one big expense account. You would list it by type of expense, right? You'd have a line item for supplies expense, a line item for insurance expense, etc. I'm just plugging them all into one big ledger account here. You'd have a separate ledger for each one of these different types of expenses because you want them to show up as different line items on the financial statements. Okay, and then what? Then I have this depreciation expense. We're going to look at depreciation here in a couple of seconds. Just know that I would go ahead and depreciate my building by using this formula up here. That means that for this year, 50,000 of my building has expired. That's an expense. I go ahead and I debit my expense and I credit my what? My accumulated depreciation. Accumulated depreciation is going to be reported against my building. When I say against my building, I don't mean on the side. I'm not going to lean it on the side of the building. When I say it's going to be recorded against my building, when I prepare my balance sheet in a minute, when someone comes up and helps me with that, we're going to sit here and we're going to see that that's going to reduce the carrying value of my building down because that portion has expired. Okay, so I go ahead, I do all that, and I think I'm ready to do my income statement, right? Can someone do my income statement for me? Since that was your little homework assignment. Geez, don't pass out over it. It's like somebody's trying to escape. Who wants to do the income statement? You want to do it? Can you write it on the tablet or you want to write it on the board? You want to write it on the board? Okay. Go ahead. Come on up. What's your name again? I'm sorry. Huh? Marlena? Okay, Marlena, what I'm going to do is give you a couple pens, and I'm going to see if I can turn this thing around without losing the screen. That didn't last long, now did it? Okay, let me see if I can do this maneuver here. I need a wireless projector. I need everything wireless. All these ugly wires. Okay. Okay, let's see. I guess I got to do. Okay, there it comes. Okay, so I'm going to go ahead and I'm going to write what you write. Okay, so can you show me the income statement? Huh? Yeah, I want the whole thing. Yeah. So we have the income statement. I'm putting IS just so I can fit it on this thing. And what are you going to put first? Going to put revenue first. Okay, good. So let me get my pen back. Okay, and where are you getting the revenue? Go ahead up there and point to me where the revenue is.
Right here.
Okay, good. It's right there. It's what? 160,000. Okay, good. So we're going to go ahead and put in our revenue. 160,000. Good. Oops. Right there. Don't let me slow you down. Oh, okay. I'm not. She's going, right? She's not waiting for me. Expenses. And the expenses are what? 61,000. Just picking them up from the ledgers. 61,600, right? Okay, good. 61,600. Okay. And so do I have some net income? Oh, she's writing every account down separately, guys. You see how she's doing that? Okay, so she's writing each one of the expense accounts. There'd be a separate ledger account for each one of them, right? I didn't do that because this thing would get too crowded if I tried to stick it in there. But good job. That's a true accountant. She's not messing around. I should take a picture of this. Put in the depreciation for 50,000. Okay, good. And when you subtract off all of those, well, you get all those expenses. Yeah, you can. Go ahead. Let me shut up. Go ahead. So you're going to write the whole thing. The total expenses are now 61,600. Right. Okay. Just give me a comma between that 11 and those three zeros, please, if you're going to be. Okay. Nice. Okay, so you got your total expenses, right? And revenue minus expenses is going to be, what do we call that? Net income, good, is going to be what? 98,400? What was that psi for? Because it was less than last year's? Oh, NI. Oh, okay. I thought you were sighing because last year we made 117,000. What the heck's going on here? Yeah. But don't forget, we've got that guy lined up. We already got some work lined up for next year, don't we? Okay, so we're feeling pretty good about that. Okay, 98,400, and good. Nice job. Nice looking income statement. She even put year 2 on that. Beautiful. Thank you. This is year 2. Nice job. Okay. Look at that. Give her a hand. All right. I'm so proud of that. Is that your first income statement?
Yes.
Huh?
First official one.
Really? First official one. Okay. That looks good. Okay, nice job. All right. So are we ready to do another statement now? No one's answering because they're thinking if I say yes, he'll make me do it, right? So what's the next statement? No. Statement, make up that statement of retained earnings first, right? Okay, so let's go ahead and make that up. Well, we can still see what the account balances are in our beginning balances in our retained earnings, etc. Right? So who wants to do the statement of retained earnings? Sir, in the back, all the way in the corner. Huh? Why? Are you afraid that the statement of retained earnings will make fun of you? Okay. Who's ready to come up and do our statement of retained earnings? What's your name, sir? Huh? Devon? Come on up. You came up last time. I'll help you. I'll help you. Here, I'll let you do it the electronic way, since your writing is probably neater than mine. Okay? Okay, so it's not too bad. Just be gentle. Okay, so go ahead and just put down SRE for statement of retained earnings right there. Yeah, go ahead. S. Okay, just right there. Yeah, SRE. Don't touch the screen though. You're touching the screen with your hand. That's why you see me hold the pen like that. That's all right. That's fine. Don't worry about those. Don't worry about those marks. So statement of retained earnings, good. Okay, and do we have a beginning balance in retained earnings? I'll tell you what, do it up on the board so you're not messing with the functioning of the tablet. It's probably not helpful for you. So go ahead and you can, yeah, okay, you can put it right there. That's perfect. Yeah, do it right there. Statement of retained earnings, and do I have a beginning balance in my retained earnings? Do I have a beginning balance in my retained earnings? If you want to know if you have a balance in an account, guys, you don't look inside your head. You do what? You look at the ledgers, and the ledgers are telling me my beginning balance retained earnings was how much? 117. Good. So my beginning balance, that was last year's ending balance, wasn't it? So my beginning balance, good, is what? 117? Nice. Okay. Do I want to add anything to that? Did you get paid last year? Huh? I'm asking you. Did you get paid last year? Okay. Did you retain any of that? Huh? You don't have to tell me what you actually made. I'm just talking to you personally. You got paid last year, didn't you? Did you retain any of that? You may have. You saved some of that, right? So your income for the year you can retain, can't you?
Yes.
Okay. So my what? I'm going to add my net income. I'm going to add net income to my retained earnings, right, everybody? Add NI. That was my earnings for year 2, and so I'm going to go ahead and I'm going to stick it in here. 98,400, right? Do we have any subtracts? What? We didn't pay dividends. Do we have to? The voice says, hey, you're going to pay me a dividend. We say, you know what? We're a little tapped out. Look, last year we made 117,000. We're going backwards. This year we made 98. Just sit yourself down and we'll get back to you about these dividends if things turn around a little bit for us, right? Or, hey, we're saving for psychedelic lights. Right? Those are the colorful lights, right? We're saving up for those lights. Once we buy the lights, because that's going to generate a lot more revenue for us, then we'll start paying you dividends again. Whatever. We don't have to pay them dividends, right? So if we had 117,090, and we add 98,000, what was it? 98,400 of our net income. What's the? Huh?
215,400.
Good. Ending balance. Say it again. 215,400, you say? All right, nice. Okay, there's my ending balance of my retained earnings, right? Okay, good. But what happens? Accountants do it with journal entries, don't we? We can't just sit there and throw some numbers down and say that's the balance of retained earnings. Thank you. So we can thank you for a good job, nice job. Let's give Javon. Huh? Devon. Let's give Devon a hand. Good job, Devon. Nice job. You see? You were afraid of it, and it was a little simple little thing, wasn't it? Piece of cake for you? Okay. See how easy accounting is? I don't know why they pay accountants so much money. I really don't. It goes back to what? It goes back to the 1800s in England. Okay. You ever see, did I tell you about this? You ever see the Scrooge? Scrooge, you've seen at least the cartoon, the Jim Carrey one was the best one, right? Okay. Yeah, Christmas Carol, right? Scrooge and all that. That was a CPA firm. They call it our counting house. It was a CPA firm, and back in those days, they were kind of looked up to because they could figure all this magic out, right? Most people can't read. And so it's sort of been this tradition that they just pay accountants a lot of money because we're supposedly professionals. Meanwhile, look at the simple little things that we're doing. Isn't this the biggest scam ever? Okay, so you want to get in on this. Right? Get in on this. You don't have to work that hard, and you don't have to be that smart, and you make nice money, right? Okay? All right. So what happens? We got to make up that balance sheet. Now, before we can do the balance sheet, we got to close these accounts, don't we? So we're going to go ahead and just like we did at the end of last year, we're going to close our revenue accounts by debiting them so they go back to zero. We credit income summary, right? Hello? Okay, so we go ahead and we debit our, where'd our revenue accounts go? We go ahead and we debited it for 160. Is it 0 now where I want it to be? Excel didn't put a 0 in there, just put a line there, but it's 0 now, right? Okay. Okay, good. Then we're going to credit the income summary. Where'd you go? There's the credit to income summary. It's sitting there with 160,000, but now we're going to close the expenses to it, aren't we? So we go back to our journals. We make the entry in our journals, debit income summary, credit the expenses. When we do, our expenses are now sitting there at 0, aren't they? Where's my expenses? When I credit them 160,000, they're 0, right? And I debit income summary, and now there's 98,400 left in there, right? So I want to close that out to my buddy what? My buddy retain earnings, and so I go ahead, I debit the income summary, 98,400, that zeroes it out. I credit retain earnings. I come over here, I post. Don't you love accounting? Look at that. Income summary is now 0. My revenue accounts, my expense accounts are 0, which is where I want them at the end of each year, right? And I go ahead and I can credit my retained earnings for 98,400. Hey, there's that balance that we wrote up here, right? That Devon wrote up here for us. So now we should be able to go ahead and do our balance sheet, right? Okay. So who wants to call out? Just call out for me, reading off of the ledger, the different numbers. Well, let's just do it together. Cash. We look at our cash balance. How much is the cash? Cash is going to be, where'd you go, cash? 217, 275? 275, 800. Okay, good. So we just write cash, 275,800. Good. Any other assets? Prepaid insurance. I think I remember that was what, 600? Okay, so that's 600. Any others? Accounts receivable. Good. How much was that? 60,000. That's because that guy had only paid me 40, right? And so we're still waiting on that additional 60,000. Good. Any other assets over here? Supplies, supplies, supplies. 13. Remember the 13,000 that were left? Okay. 13,000 apples, supplies. Now I don't know why I wrote this down so low. 13,000. Okay, good. Any other assets? Let's do the equipment first, okay? Since somebody said equipment. What's that, 150,000? Okay, good. Now what? Okay, good. So we've got the building. The building we bought originally for how much? 1,200,000. So we still show what we paid for it. We still show what we paid for that building, 1,200,000. And then we say less the accumulated depreciation on that. And the accumulated depreciation is only 1 year's worth, right? And we said that the accumulated depreciation is 50,000. Was that what it was? So that's 50,000. We're subtracting that off of the building because that much of the building has expired, hasn't it? And, you know, the building's not quite as shiny as it used to be, right? It's got a little bit of a nick here and there now, right? Okay, so we show that through that accumulated depreciation. Good. Any other assets? Any other assets? That's it? Okay, who wants to total up them assets for me? Try it with the calculator. Try it. It's beautiful. What's the total here? 1,649,400, you say? Do I have a second on that? Okay, good. A confirmation on that. Thank you. Okay, good job. Okay, let's go ahead then. We've got to list our liabilities now, don't we? Okay, what's our liabilities? Let's see. Those were up here, weren't they? Still haven't paid on that mortgage. I mean, realistically, we would have paid some down on that, but I didn't want to put every single transaction here. So our mortgage payable is still how much? 200,000. Okay, good. Huh? Question? Okay, what else? The vehicle payable. Okay, good. So I'll just put that as VP, I guess. 150,000. Okay, good. Anything else? The account payable. What? We haven't paid for those supplies yet, huh? We better get paying on those because the supplies are half gone already, aren't they? But we'll pay on those later. 24,000. Okay. Unearned revenue, huh? Okay. I'll just call that unearned. Unearned revenue. How much was that? Still 60,000? Okay, that's 60,000. Okay, good. Any other liabilities up there? Any more liabilities? Looks like we got them all, right? Okay. Okay, good. So if that's all of those now, what's my total liabilities? 434,000. Okay. 434. Okay. And now we just got to get our stockholders' equity, don't we? Stockholders' equity is our common stock. Common stock is still $1 million, isn't it? Nothing's happened there, so that's still $1 million. And we already have determined that our retained earnings is what? 200 and where's my retained earnings? 215,400. Okay, and the total, I'm out of space here down at the bottom. No, I guess I got a little bit left. The total of my stockholders' equity then is how much? 1,215,000, you say? 400? Okay, good. And what's the total of my liabilities now and my stockholders' equity if you add those two numbers together? And I'm going to write it over here on the side. 1,649,400. Beautiful. Don't you love accounting? No matter what you do to it, it's going to come back at the end and work out for us, isn't it? As long as we follow the rules. Right? Where did this number come from? No. It's the what? It's the liability plus what? Plus the stockholders' equity, isn't it? Right? I just couldn't write it at the bottom because I ran out of space, right? Isn't that beautiful? Look at that. Yes, sir. That's the stockholders' equity. It's the common stock plus the retained earnings is in my stockholders' equity, right? What two accounts make up stockholders' equity? Sir? What two accounts make up stockholders' equity? Common stock and retained earnings are the two accounts that make up retained earnings, right? And so that number that you asked me about was the total stockholders' equity, which was the sum of the common stock and the retained earnings, right? Right? And then I took that plus the liabilities of 432,000. You add this number together. You add this number together. You add this number together. You get this number, and that's because assets equal liabilities plus stockholders' equity, right? Right? How did we get there? By making sure each time in our journal our debits equal our credits. We post those to the various ledger accounts. We pull from our ledgers our financial statements, right? That's it. Anything else we learn in this class is going to be a fool's game of, okay, well, now we have this. So the journal entry, the debit and credit should be that. Well, now here's another little thing. So the debit should be this, the credit should be that. Now we just start playing jazz with this, don't we? Yes, sir. 50,000 is the accumulated depreciation on the building. We debited our depreciation expense. We credited the accumulated depreciation to show that that much of the building has expired, hasn't it? Okay. Question? Uh-huh. Well, I put them there. I mean, they would be revenue and expense accounts, so they would fall in that category of our chart of accounts, the revenues and expenses. Well, I stuck them down there in part to make it all fit, but also I could have put them on the other side under, assets, but I put them under the liabilities, huh? Well, because assets equal liabilities plus stockholders' equity, and so I'm putting them down there so that you're seeing that our equation is staying in balance as we do all these transactions, and the revenues and expenses are ultimately going to wind up in the retained earnings account, aren't they? Once we figure out our net income through our closing entries. So they kind of belong down there for this lesson. Okay, but if we're looking at a ledger account, if we're looking at ledger accounts, we organize them by assets, liabilities, revenues, expenses, dividends, essentially, right? And did I say stockholders' equity? Assets, liabilities, stockholders' equity, revenues, expenses, the way we organize our chart of accounts. Okay? If you didn't buy the book, there's a slide that I'll show you in a minute that's got a chart of accounts. If you did, I think there's a chart of accounts in the front of the book that you could take a look at. Okay? Yeah, that slide of a chart of accounts. I'll put it up here in a couple minutes. That slide combined with that arrow slide are the two most important slides because you need to know whether an account is an asset account, a revenue account, a liability account, an expense account, so you know whether to debit or credit it. That's probably the hardest part of accounting, is just remembering that, right? Because everybody doesn't sit there and say, okay, which one's a revenue, which one is expense. That's the part that you're going to have to get down pretty quickly, right? Sort of like if you want to spell, you got to know the alphabet type of thing. Okay. You want to take the break, or you want to start coming up and making some entries so you can see how the civilized world does this now? I'm thinking we take the break right now, and I'll set this up and I'll see if I can get us. Yeah, this is the point to take the break. I'm going to take the break now and see if I can set this up and get Connect going in here. If I can, I'm going to have to flip over to the other laptop. So let's take the break now. I'm thinking let's just do 7:30. Take it 15 minutes, and that way you're not sitting here watching me fiddle around with stuff if I can't get it to work. Okay?
This is grayed out. So we use this as a chase because it has all the different calculators. So I can use the FNC calculator. Has your regular, but you can start like figuring ROI or different things. It's all comes with it. It's a free app.
FN calculator?
FNC, yeah, FN calculator.
Okay.
So that's a good app.
Oh, okay. I'll have to check that out.
If you
Yeah.
like it, then tell me.
Okay.
Give it to me. I had a class, it was like a little math class a while back. Had this in it as well. So.
Oh, okay. All right. Thank you.
Classroom is your office hours then?
4 to 6. I'm in the accounting lab, which is you know the computer lab. They got that banner there. It's right next to that. Yeah. Yeah, that door, it's not for an accounting lab, it's somewhat uninviting because they locked the door. So your best bet is to call me on my cell, and I can come and open the door. Otherwise, you're going to be pounding on a steel door. I don't know why they don't open it up, but yeah. Okay, yeah. Hi. Okay. Okay, 1 second, please. Let me turn this off, okay? Because we're still being recorded here.